using exhibit the right calculation of the rectified that error here. Hi students, how are you? Welcome in the practice session of SBR. In this task, I'm going to debrief a question from your past exam, and it is March-June 2024, and it is a question number 1, which basically cover the group accounts. So the question name is PEONY Company, and today we will discuss this question. So here we are, and this is the question which we are going to discuss today. First of all, let me give you a briefing that what topics we basically going to cover here. Dear student, in this question we have a foreign subsidiary for which we are going to adjust the statement of financial position. In this question, we will cover the concept of functional currency and the impact of change in government regulations over the control of the subsidiary. So these things we will be basically covering in this question. Now, without wasting any further time, we have requirements here. In our first requirement A, they are asking using exhibit number 1 and in accordance with IAS 21, the effects of change in a foreign exchange rate, explain why Nomestra company's functional currency is NY. NY is the name of a currency, and they are asking that why the NY should be the functional currency of a Nomestra company. So here we have the exhibit number 1. Now, in this question, as you just need to explain and discuss, so you would be using the word processor to answer this requirement exhibit number 1. So, Nomestra company is a foreign subsidiary of the PEONY company with a functional currency of NY. Nomestra company sales and related costs are predominantly determined and settled in NY. PEONY company had the previously provided a supporting loan in dollars to Nomestra Co, which had been settled during the year, and funds from the financial activities are currently generated in NY. Nomestra company board of directors is free to determine its decisions independently from the board of the P company. So why we should treat the NY currency as the functional currency of the Nomestra, the subsidiary of the parent. Now, in the start of the question, the first thing we need to write down is the definition of the functional currency as per IS 21. We will define the functional currency. And what is the definition? The currency of primary economic environment. The currency of primary economic environment is known as the functional currency. That is the definition. First, we will define the functional currency. Number two, after defining the functional currency, the next thing will be to discuss the functional currency of an foreign operation. Functional currency of foreign operation. In this discussion, you will consider that whether the functional currency of the parent company, which is the PEONY company, whether the functional currency of this parent company can be considered as the functional currency of the Numestra company. Numestra is a foreign operation. Now, in this regard, we have a guidance from IS 20, and it is in a summary. If I discuss the summary, if the foreign operation is an extension of the parent company, not acting independently, not taking their decisions on their own, but they are dependent on their parent company for their decision making, for their financing need, from their volume of trade. If they have dependency on their parent company, in that case, the functional currency of the parent company will be considered as the functional currency of the subsidiary company. Now we need to consider whether in this case the Numestra company is just an extension of the parent company, or the Numestra company is an independent company with the full authority to taking their own decisions. Now, this fact we have in a question, and the fact is that the Numestra company generates its finance on its own. The funds from the financial activities are currently generated in NY. So that means the parent functional currency cannot be the functional currency of the foreign operation. After considering that, and further, the board of directors is free to determine decisions independently. So we can say conclusively that the functional currency of the parent is not the functional currency of the subsidiary. Then, in a third stage, now you need to identify then what is the functional currency of the Numestra. Now, in that discussion, we have in IS 21 primary factors, and secondary factors to determine the functional currency. In primary factors, we have the currency of sale, the currency of operational expenses. In a secondary factors, we have the currency in which they generate their financing and the currency in which they retain their earnings. These factors will be applied. Now, if we apply these factors, you can see that the sale and the related cost are predominantly determined and settled in N1. The primary factors indicating the functional currency of the Nomestra should be N1. And further, their financing needs are also generated in NY. So considering these facts, we can conclude now that the functional currency of the Numetra will be the NY. So at the end, you will conclude it, and in your conclusion, you will give your opinion that the functional currency of the Numetra should be the N1, Or you can say these are the reasons due to which we are concluding that the NY should be the functional currency of the Numetra. So that was the first exhibit. Now moving towards the second exhibit, which is a B, in which using the exhibit 2, the first thing you have to calculate and discuss how to correct the treatment of Novestra company in a consolidated financial statement of the P group for the year ended 31st December X2. 31st December X2. We have three issues. There are some mistakes. So we have to calculate and we have to discuss that how those mistakes should be rectified in a financial statement of 31st December X2. And then we have to adjust these things in a pre-populated balance sheet of the foreign subsidiary. That is the second part of the requirement B. And both of these two requirements have total 20 marks. Now, the calculation part will be done in a spreadsheet and the discussion part will be done in a word process. So when you did the calculation, then after the calculation you can discuss that how you have calculated and what are the logics behind those calculations you can discuss here in a word process. Now, coming back to the three issues. First of all, the introduction on January 20X2, P company acquired 75% of 1.5 million NY ordinary shares, one ordinary shares of Nomestra company for 1.1 million US dollars. When the retained earning of the Nomestra was 4.8 million, they were Nomestra company. There were no other component of equity. P company determined the value of the NCI at the date of acquisition at fair value, which is 2.7 N1. During the year, they reported a loss of 900 NY. No dividend were paid or proposed, and at the year end, their net assets are 5.4 million N1. Exchange rate at the date of acquisition, the exchange rate was 12. At the year end, it is 18, and weighted average rate is 50. Now, first of all, let me discuss the rules. Dear students, the net assets of the subsidiary at the date of acquisition, NCI value at the date of acquisition, and the consideration at the date of acquisition should be translated using the rate or the exchange rate at the date of acquisition. At the date of acquisition. So goodwill should be calculated using the exchange rate at the date of acquisition. Secondly, if there is any impairment on goodwill, normally that is translated using the average rate. And then the closing value of the goodwill is translated using the closing rate. And if there is any difference, that is regarded as an exchange gain or exchange loss, and that exchange gain or loss is reported in other comprehensive income. And on the time of disposal of the subsidiary, if there is a disposal, then those cumulative exchange and gain or losses are reclassified to profit and loss account. That is the brief rule of the of regarding the calculation of the goodwill at the date of acquisition and subsequent. Now, the first issue we have here is regarding the calculation of the goodwill at the date of acquisition. They have calculated the goodwill incorrectly. They are telling us in a question. And they have calculated the value of goodwill at 7,25,000 US dollars. And they have included this goodwill in a draft balance sheet. In arriving this value of the goodwill, the mistake which they have done, they have translated the NCI at the date of acquisition using the exchange rate at 31st December 20x2. 31st December 20x2. Using the closing exchange. Using the closing exchange, they have translated the NCI. Instead of translating the NCI at the date of acquisition using the rate which is at the date of acquisition. So that is their first mistake. We have to rectify that mistake, and then we have to discuss that how that mistake will be rectified in a consolidated financial statement. Okay. Now, for calculation purpose, we will utilize the spreadsheet in which a pre-populated balance sheet is already given to us. And I have already did some calculations, and now I will explain the explanation. Now, first of all, issue number one regarding the calculation of the goodwill. The goodwill should have been calculated. Investment at the date of acquisition is 1100, 1.1 million. I am taking 30 common. So 1.3 million, 1.1 million is the value of the investment at the date of acquisition. Then the value of NCI. Now look at here. The value of NCI at the date of acquisition was 2.7 million. They have translated it using the closing exchange rate, which is 18 NY equals to $1. But the rate at the date of acquisition was 12. Rate exchange rate at the date of acquisition was 12. So if I calculate this rate using the exchange rate at the date of acquisition in dollar terms, the value of NCI is equal to 225 US dollar. 225 US dollar. But when they have translated this same NCI using the closing rate, they have determined the NCI value at 150 million US dollar. So that is the first mistake in the calculation of the NCI. So when you rectify the NCI, you can see your value of NCI has been increased by 75 million US dollars. So that the total value of 1325 has been changed. And after that, your value of net asset at the date of acquisition was 6.3 million US dollar, 6.3 million US dollar, 1.5 million NY, sorry, not dollar, NY, not dollar, NY. 6.3 million NY net asset value at the date of acquisition. 1.5 million is a share capital, and then you have 4.8 million NY retained earning at the date of acquisition, and there is no other component of equity other than the retained. So combining these values, you have valued the net asset at the date of acquisition is 6.3 million NY, and the exchange rate at the date of acquisition is 12 NY is equal to $1. So in dollar term, it is 525. So resulting goodwill you have is 800. And the goodwill which they have determined is 725. So after rectifying this mistake, your value of the goodwill has been increased by 75, only just due to the right calculation of the NCI. And as I told you, that value should be determined using the rate which is at the date of acquisition. Now, this is the correction in which the goodwill is debited by 75 and value of NCI is also increased by 75. And if we discuss the adjustment in the second part of the requirement B, which is the pre-populated balance sheet, you can see here in a C, you can see here, I have given a heading, the NCI at acquisition. Basically, I am adjusting the value of the NCI, and you can see that the value of NCI is increased by 75, and in that result, the value of goodwill is also increased by 75. And I have recorded this double entry in the pre-populated balance sheet. So that was the first issue which we have resolved. Okay, the calculation we have done here, and you will explain your calculation and the outcome in a word processor. Without explaining, without a discussion, you will not get your full marks. People will not get the full marks. Now, the second issue comes back to the exhibit number 2. During the year, the goodwill of the foreign subsidiary is impaired by 3.3 million NY. They have calculated the impairment, but they does not incorporate this impairment in the calculation or in their financial statement. And they translate the impairment on goodwill using the average rate. And average rate, if you can see, the average rate is 15 NY, Now look at it. The impairment has not been recorded. So if you look at here, your impairment is 3.3 million. Translated using the average rate, in dollar terms, your impairment is 220. And impairment means the goodwill has to be decreased. And they didn't record this impairment, and we have to record the impairment. And now when we will record the impairment, which is after translation in dollar, is 220. This entry, I'm highlighting in the circle, this entry should be bar, in which goodwill should have been credited by 220. And as we are using full goodwill method, as we are using a full goodwill method, so 75% of the impairment should be charged against the group retainer and 25% should be charged against the NCR. So 75% is equal to 165 and 25% is equals to 55. And then in a pre-populated balance sheet, the statement of financial position, impairment of goodwill. Goodwill is impaired by 220. You can say goodwill has been decreased. 75% of that impairment is charged against the retained earning and 25% has been charged against the value of NCR. Value of NCR. Value of NCR. 220 goodwill is credit and 275% is debited in the retained earning, which is 165, and 25% debited in NCR, which is 55. So that is the second issue regarding the impairment on goodwill. Now another thing here is that the goodwill should also be translated using the closing exchange rate. Closing exchange rate. Now, to cater that thing, look at here. We have another, I have done another work, which is a goodwill in the currency of NY. So in NY, if I translate the value of 1.1 million US dollar using the exchange rate at the date of acquisition. In NY, the value of the investment is 13.2 million. Value of NCI is given, it is 2.7 million. So total is 15.9. And the fair value of the net asset in NY at the date of acquisition is 6.3 million US dollar. So the goodwill at the date of acquisition in NY is 9,600 in NY currency, and if you translate it using the exchange rate and dollar and 1 is equal to 12 NY, it would be 800. And then in terms of NY, there is impairment of 3.3 million. So after considering that impairment, your closing goodwill in NY should be 6.3 million. Should be 6.3 million. Now this 6.3 million should be translated using the closing exchange rate, which is 18 NY is equal to $1. So the closing goodwill should be 350 million US dollar. But if you look at here, your goodwill at the date of acquisition was 800. Then you have impairment of 220. So your closing goodwill, if we consider only these two figures, your closing goodwill should be 580 million. Should have been 580 million US dollar. But it is 350. And this decrease is only due to the exchange loss, which is the balancing figure, and it is 2/3. And now you have to record this exchange loss as well. And this is the entry where I have recorded this exchange loss. The goodwill again is credited by 230. 75% of loss is allocated to group translation reserve and 25% is allocated to the NCR. 25% is allocated to the NCR. And now if I show you the impact of this entry in the pre-populated spreadsheet, you can see here You can see here, goodwill is credited with 230, 230, 75% of this 230 should be recorded against the translation reserve, which is 172.5, and 25% should be recorded against the NCI, against the NCI, against the NCI. Okay, so 75% against the translation reserve and 25% against the NCI. These both accounts are debited and goodwill is credited by 230. So here we have concluded the goodwill. Now coming to the third issue. Now the background of the third issue is that we do our exchange gain loss analysis in which we translate opening net assets using opening rate and then closing net asset of the subsidiary using the closing rate, and we get the total movement in a net asset. And then in this total movement, we exclude we deduct the movement due to the profit for the year or loss for the year using the average rate. And when we adjust that, you get only movement which is due to exchange rate movement. And that exchange rate movement we reported in other comprehensive income or in a translation reserve in a statement of change in equity. Now the mistake which they have done here, they translated the closing net asset using the closing rate, opening net asset using the opening rate, but the mistake which they have done is they translated the loss for the year using the closing rate, and at the end, as a result, they have recorded an exchange loss of 175, which is presented in a translation reserve, But the problem is that the exchange, the profit or loss for the year should be translated using the average rate, not using the closing rate. Now, I have rectified that error here. Opening net asset, which are 6.3 million, translated using the opening rate, which is 12. In dollar term, it is 525. Closing net asset is given in a question 5,400, translated using the closing exchange rate 18. It is 300, and there is a total negative movement of 225. Total net loss of 225 in the net asset. Now, in these net assets, this total loss also includes the loss for the year, translated using the average rate. Now, if I exclude that loss, which is 900,000, and translated at average rate, if that net loss, which is due to the profit, is excluded, the remaining loss is 165. And this remaining loss of 165 is the exchange loss, which should be reported in a translation reserve. But they have reported 175 losses. You can see here 175. You can see here in B80 175. 175. But the loss which should have been reported here should not be more than 165. Should not be more than 165. So when we will rectify that error, the loss of 10 will be reversed. So the translation reserve will be credited with $10. So 175 negative positive 10, it will give you 165. But there will be another impact, that is the credit side where you credit the translation reserve. But obviously there is another problem, and the problem is that the loss you have translated using the closing rate, which give you a loss of 50, which you have reported in your group reserve and NCI. But this loss is 50, but the actual loss after translation using the average rate should be $60. So the loss which is allocated to group and NCI for profit and loss, the loss which should have been allocated between group and NCI should be 50, should be 60, but they have allocated $60. So remaining 10 loss will be allocated between group and NCI. So 10% of the loss will be debited in group retained earnings, 75% of the loss will be debited in group retained earnings, and 25% loss will be allocated to the NCI. So group retained earning is debited with 7.5, NCI is debited with 2.5, and translation reserve are credited with $10. After that, the last issue is that the translation reserve which they have recorded here, which is 175, that loss is not distributed between NCI to the NCI. It is totally allocated to group, but 75% of that is relating to the NCI. So 175 and 10, now we have 165. Now 165 loss should be deducted from the translation reserve and should be allocated to NCI. And you can see here that with 25% of 165, 175 minus 10, so 165, 25% is credited in translation reserve and debited in NCI. Debited in NCI. Debited in NCI. And now, after adjusting all these values, now you have the final column in which you have now adjusted statement of financial position. There is no change in a property, plant and equipment. It is 18500. The value of goodwill has been changed to 350. Then you have the total assets here, which is a combination of 18500 and 350. Total assets. In the red color, I have given color to the total assets. Then there is no change in our current assets. And here you have the total assets, which is 22,050. 22,050 is the value of total. Then on the equity and liability side, there is no change in the share capital. It is still 6,000. Group retained earning has been changed. We have the goodwill impairment. Then we have the adjustment relating to the translation of the loss for the year. So closing retained earning adjusted 15290. Then we have translation reserve, which were 175. Goodwill loss allocated to group is 172.5. 10 is the adjustment relating to again the issue which is relating to the translation of the loss for the year. Then allocated to NCI of 175 minus 10, 165, of which 25% related to NCI. So the closing net loss reported in translation reserve is 296. Then you have total equity. Then this is your value of NCI after the adjustment. You can see the formula applied, taken the sum. And this is the total value of This is the total value of NCI and the equity, 2105. Then there is non-current liabilities 200, there is no adjustment. Then we have a current liabilities of 800, there is no adjustment. You have total liabilities, and here you have total equity and the liability, which is 22050, and you can see it is equals to the asset side. So here we have adjusted the pre-populated spreadsheet along with the calculation. So we have simultaneously discussed the requirement B part 1 and requirement B part 2. Now the final requirement, and that is using the Exhibit 3, discuss the potential impact of change in government regulation on accounting treatment of the Numestra company in a consolidated financial statement for the year ended 31st December 20x3. 31st December 20x3. So, exhibit number 3, changes in the government regulation. Near the beginning of the following year, December X3, changes were made to the government regulation in a country in which Numestra company is located. This has significantly impacted the Numestra company operation and caused a fall in the value of NY. Directors are aware that due to the change in the government regulation, Numestra company is no longer permitted to transfer funds to the P company. Moreover, the government restrictions have been enacted which limit the extent to which the P company can exercise the rights or governance over the Numestra company. Now, basically here, what we need to discuss, there is a change in government regulation and that is restricting the parent company to exercise the power over its subsidiary. So it is a matter of IFRS 10, which defines the control. We have to discuss whether the control has been lost or not, and then what would be the potential impact on the accounting. The control, if we define the control, it is a power to take the financial and operational decisions of the company. And that control you have if you have a power over a subsidiary, power to control, and you are exposed or you have a right to variable returns, and you have an ability to exercise the power to effect those returns over the investing company. So if you have a power, if you have, and that power comes to majority shareholding if you have more than 50%, or through the Management Contract Act, or if in a substantially, if you are the single only major shareholder, that gives you a power. If you have invested in equity, so you have a right or exposure to the variable return. And if you have the ability to use that power, that means you have a control over the subsidiary, and that is your subsidiary company. And in that case, the Numestra is the subsidiary. But in X3, there are changes in a government regulation, due to which you have restricted to do certain things. One of the thing is that the Numestra company would not be able to transfer fund to the parent. Now, as far as the fund transfer is concerned, it does not undermine the control. But the problem is that the government regulations have imposed restrictions on the P company to exercise its power over the subsidiary. Now, this is the matter of the concern and worry, that due to this thing, you may have lost the control. You may have lost the control over the subsidiary. And if you have lost the control, then you have to account for a disposal of a subsidiary company, where you have to de-recognize the assets, liabilities, goodwill, and NCI of the subsidiary, and you have to record a group gain or loss in your consolidated financial statement. Further, if you have to consider whether it is a discontinued operation or not, that factor also need to be considered. Secondly, if you have loss of control, then after the loss of control, what is the status of the subsidiary? That needs to be defined. Now, if you have still a power to have a significant influence, then the domestic company should be accounted for as an associate company, and it should be accounted for using the equity method as per IS 28, accounting for associate and the joint ventures. And if you does not even have a power to have a significant influence, then it should be considered as your ordinary investment, and ordinary investments are accounted for under IFRS 9. Financial assets, and it is equity investment, so it should be classified at fair value through profit and loss account, or it should be designated, most likely designated to fair value through other comprehensive income. In each case, you will measure the fair value at each reporting date, and any resulting gain or losses would be recorded in profit and loss account or in other comprehensive income, depending upon the classification of the post loss control of the domestic company. If you does not have the power to influence it, whether you have classified it at fair value through profit and loss account or fair value through other comprehensive income. Okay, so student, that was the basically debrief of the version of March June 2024 of the PEONY company, and I hope that it would help you to understand that how to deal a question, especially the question number 1 in your upcoming exams. Okay, so this series will continue. In the next series, in the next video, we will discuss another question. Till then, goodbye and take care.